From the morning reading, for bulls hoping that this uptrend would lead to a decisive break from months of range-bound action, the situation is looking like more of the same. The market's current difficulties are not much different than what has been the case so far this year. Traction, for the most part, has been missing on both the downside and upside. Here's a statistic that puts things in perspective. Thursday was the 101st trading session of 2015, and 50 of those days have been spent with the market in the under pressure zone. When was the last time indefiniteness ruled to that degree? Never, if the test is the same period in the last 7 years. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 7:20 a.m. Central Time, and I'm recording this in preparation for market day, June the 1st, 2015. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. Let's dive in and see what happened in the Sunday night activity. In our markets, slightly bullish. At the time I cut this, we were basically scratch on 3 of the 4 markets. We seem to have had a little bit more bullishness since the S&P futures are up 6, NASDAQ are up 22, Russell up 10, and the Dow is up 73. And that's all running about anywhere from 0.3% to 0.82% on the Russell. That being said, there's a lot of news that's going to be coming out for a Monday, so things could very much change between now and market open, and certainly shortly after market open. Crude oil was down about 1%, euro down about 0.57%, bonds down about 0.5%, and gold down about 0.34%. Remember, China had the big pullback last week when they changed margin requirements. Some of the big broker houses, they were down like 6.5%. Well, indeed, big bounce back. That proved to be, at this point, looks like a value opportunity. China is up 4.7%. Hong Kong up 0.63%. Japan scratch. Germany scratch. United Kingdom scratch. In terms of those macroeconomic reports for today, on the U.S., you have manufacturing PMI. That's the Great Britain. Ours is core price index, personal spending. You have an FOMC member speaking right at the market open. That's always tricky. And then you have our own manufacturing PMI. That's the one I was looking for. I thought we had PMI today. And then ISM manufacturing. So there's quite a bit going on, even some more yellow reports on top of that, such as construction spending and the like. So quite a bit for a Monday. Obviously, this is the week in which we have the first Friday of the month, so that big monthly unemployment report should be this Friday. So this actually could be a fairly significant week. In terms of our volatility conditions, obviously we did have quite a bit of weakness on Friday, and you see the short-term VIX now 13.67, IV percentiles 23, 13, 21, 34, a little bit elevated from what we've had in some recent days, but at the same time, keep this all in perspective. A short-term VIX at a 13, an IV percentiles at 23s and 13s and so forth is not a market with a lot of fear. You look at standard deviation moves. We had one, the NASDAQ, on Friday. Relatively quiet. We normally see about 2 a week in the S&P, so you can see for the most part we've actually been pretty quiet on these kinds of moves of late. Let's go ahead and go to let's take a quick look at the charts actually. A couple things. We've been watching, of course, the transportations, and transportations continue to fall. And really, if you look at it now, there doesn't look to be any significant obvious support. You've got a gap fill here that'd be around this 147 and change area. And then after that, it just gets ugly. It could you probably would want to look at a fib cluster or some sort of extension as to where the transportations might fall. If the transportations indeed do fall like that, it's hard to believe that the broad market is going to be doing anything significant to the upside, and indeed could face significant exposure to the downside. Here's the S&P. You see the weakness that we had. Obviously, we've got some key moving average lines. The 50 is in this area. On the futures contract, we're basically looking for about 2102, 2100. 2099 is, I believe, where the 50 moving average would be. Those are very, very important areas. Now, right now, in the pre-market, we're up around 2112, and that would not seem to be, of immediate concern. But if you see that the market starts the day out with a little bit of a bounce, and then rolls over, and then has a weak day, watch to see where that weakness gets to. If the weakness comes down a little bit, but then the bulls hold, that's one thing. But if the weakness continues to fall and we start breaking through the 2102, 2100, 2099 area, and we have a significant break of that 2099 area, then that could be something that could lead to a couple days of significant weakness, and you could have us back into the middle of this larger trading range that we were in for so many weeks, and probably something much more significant. Now, obviously, in recent trading sessions, we finally had that breakout, but then that went into low volume up days leading into the holiday. But as soon as everybody came back from the holiday, very ugly reversal, and then ugliness again. So in bulk, the market has a intermediate bullish bias, but a very short-term bearish bias. That makes for the potential of volatility, which can be good, choppiness, which can be very difficult, and a lot of cross currents. You could have some trade setups that are doing fine because they're set up on short-term time frames, and then other trades that are more core portfolio seemingly under pressure. So this is one of those things where your trades are very, very time sensitive. You got to stay in context with what your time frame expectations were in the setup of the trade. Longer term trades, we might have some significant pressure coming into that in the next day or two if the shelf doesn't hold. If you actually look at the intraday on this on Friday, we bounced off the same area multiple times. There's basically a shelf sitting in this area about 2102 area, and that could be important. In other markets, the Russell, you see here, continued weakness, and certainly from a relative standpoint, not holding up terribly well. That's another concern for the broad market. And then the NASDAQ. NASDAQ also has not exactly been lighting anything on fire. Dow Jones really fallen off, and it made its new high earlier than the S&P, but actually had a lower low on Friday. So this just doesn't look very good for the broad market. Let's take a look at a regular daily report. Big picture, we're still IBD status, confirmed uptrend. GMI index fell one tick to a 5 out of 6. But look at the as we start to dial down into this, the market posture has actually turned bearish. You have the S&P bearish, Dow bearish, Russell bearish. Only the NASDAQ remains as bullish, and it's just holding on. If this ticks down below an 80, that will also turn bearish on the intermediate term. You have position sizing opinions that are still at 100%, given that we have this confirmed uptrend and the volatility where it is. There has not been any significant fear in this market as measured by the VIX at this point. So we remain at this 0 plus, normal with cautionary aspects, and I would probably underline cautionary aspects as we go into this morning, in that we had several more warnings come into place from our volatility segments. We had market and decline and sharp increase warnings fire. We still had that VIX daily squeeze present. Our distribution day count for so early into this current market and confirmed uptrend is starting to climb. We have NASDAQ at 3, S&P at 2. The skew was over 125 at the Friday close, so that's a caution there as well. Look at the new highs, new lows. Over 300 on the new lows. That's a warning sign. We still have that crash warning that's sitting out there on the daily chart. And then, of course, we have 3 of the 5 risk aversion indicators that have flagged as risk off currently. So you add all this up, that's a lot of red for a market that is supposed to be confirmed uptrend. And so we're going to watch this action today and tomorrow and see just where this comes from and what it might lead to. But this is not a healthy bull market at this point, in my opinion. From the separate opinions, option income strategies, that VIX is still inside the acceptable window. If we do remain range bound, that is optimal for option income strategies. Just keep in mind, you got to stay on top of increasing volatility, which could lurk itself and increase at any time. Covered call strategies, cautiously bullish, but you're going to be happy that you have those in the money strikes, and we're calling for a 3-to-2 distribution between in the money and out of the money strikes. You're going to be happy that you have those in the money strikes if we stay in this range bound activity, or if we indeed have that weakness that could very easily bring its head to bear. Put selling conditions are acceptable, but consider put credit spreads with defined risk and consider scaling into positions. We remain cautiously bullish in that longer term, and yet have significant levels of additional risk that we want to be mindful of with our put selling strategies. Another reason for warning is our relative rotation graph. We saw last week a lot of these were coiling over, and look at this week. It just gets uglier. In fact, really only KRE is in the upper quadrant. If you saw the entire graph, there's actually 4 boxes. This upper right quadrant's where you want to be, and you see KRE is the only one that is green in the upper right box. All the other areas have been weakening. Not good. From a sector market posture, a lot more red on here after Friday. Healthcare holding up the best, so that is of note. And then, of course, you see red all over the place on the 1 and 5 day. But also, look, you know, when you start to see 1 day, 5 day, 1 month, 3 month with significant amounts of red, you know, this is starting to become a market in distress, potentially. And, you know, this just isn't very good when you've got, you know, telecommunication is red for all these time frames all the way back to 3 months. Same thing with consumer staples, materials, industrials. It's negative all the way back through the 1 year. So on the year to date, I should say. So there are not a lot of sectors that are high performers and consistent high performers right now. Really, financials. I mean, this is slightly negative on the 1 day and 1 week. 1 month just barely above scratch. 3 months just barely above scratch. Year to date negative. Yearly, you know, there's really nothing to say, hey, I want to go and invest a bunch of my capital in this because it's been a consistent high flyer. There's nowhere to go from a sector standpoint right now. And remember, as the sectors go, you know, about 80, maybe 85% of individual companies within those industry groups will go as well. So not an easy market to be looking for positive growth in a kind of conventional sense. So always watching your watch list, of course. If things do break out, especially, and we get something that starts to get some legs and some strength and some volume to come into it, you would want to be looking at some of these areas. But In general, not an easy market right now for core portfolio traders or swing traders. Much easier, frankly, right now to be an option income trader or very, very, very short-term kind of trading activity. Keep those targets relatively smaller and keep that risk very much in check. Keep those position sizing down until this situation resolves itself and we start to get a market which is more conducive to being able to hit targets. So most of this action here, we got to go all the way back. In fact, if you went to the prior range, you go all the way back to November of last year. Big trading range, reset, new trading range. We thought we were going to get a breakout and maybe get a new trading range, but then just fell right back into the prior trading range here. And until we really kind of find some feet, this is not a market to get super aggressive on. Okay, that should be enough for today. As always, if you find what you're getting here as supportive to your efforts, we also appreciate you supporting us by liking us on YouTube and sharing what you have found here with your trader friends. More information about how we actually apply all this to our daily trading, and we model everything that we do in our Portfolio and Options live trading chat room. More information at this website. We are very transparent. We model our activity from beginning to end and record that in our trade journals and logs and so forth. And using a modeled position size, you can see we've had a very nice performance curve this year, even in a market that has really not gone anywhere. I know the S&P through the end of the month was up less than 3% for the year. And we're certainly happy with the performance we have against that backdrop. The free trials are available. Disclaimers as always. Hit the pause button if you need more time to review this. And we'll look forward to being back here tomorrow morning before the market opens with our market preview. Thank you.